With this, we move into the next panel, which fits very nicely on this previous intervention, because it looks at supervisory technology, it looks at artificial intelligence, and it looks at how markets are changing and what that means for supervisory behavior. And to discuss this with me, I've got an excellent panel. I've got Tom Mutton. Congratulations, Tom, from Bank of England, for publication of your consultation just now. I know we're not going to talk about consultation on stablecoins, but nonetheless, anybody who's interested should read it after this conference and respond. Lukasz Kubicki, who is the head of Subtech in the Single Supervisory Mechanism, so the European Central Bank. Anita Kimber, who is the EMEA Business Transformation Leader for EY. So very interesting to see on the ground what the industry is doing and how it's impacting the approach to supervision. And finally, and certainly not least, Marius Georgilas, who those who have followed this conference will also remember from previous conferences, who is now a professor at Vilnius University, previously worked also at the Lithuanian Central Bank and led the work on innovation. Thanks for being with us. And maybe, Tom, I start with you, because I know the Bank of England has looked and is looking at the application of artificial intelligence and use cases, technological use cases to facilitate the supervisory process. Maybe I pass over to you to give a bit of a sense of what you're doing.
Yeah, well, thanks for the invite to be here, Nick. It's great to be with you all, and thanks for the congratulations on the digital pound consultation paper. So in terms of artificial intelligence, big emphasis for us in the bank. We did surveys in 2019 and again in 2022. Those are public, so go and take a look. We stood up an artificial intelligence public-private forum made up of academics, technologists, industry practitioners, financial sector experts. We asked that group actually to think about how we could support the deployment of artificial intelligence in financial services in a safe way. And they published their report last year. That raised some really interesting questions, including the extent to which regulation was a blocker on the adoption of artificial intelligence. And they actually encouraged us to think about artificial intelligence, both in terms of how the bank might use it as a supervisor, but also in particular about how firms might use it in terms essentially of 3 layers. And I don't think this is radical, but it is nonetheless useful, I think, to bear in mind. The first layer being the data layer. The second layer being the methodologies, techniques, and models that represent artificial intelligence. And then thirdly, governance and senior management responsibilities, including risk management. And 2 points they really wanted to emphasize within that. First of all, for them, and I think this is absolutely right, everything starts with data quality. And the success and safety of an artificial intelligence deployment really stands on the quality of the data. So the foundation is data quality. And then secondly, to be very conscious of the feedback loop and the dynamic feedback loop between the data and the model, and to think about things like bias, which can come out of that. Also questions like model drift, unexpected results, etc. So that's been very helpful. What we are also interested in doing is monitoring very closely through those surveys how firms are using artificial intelligence. 72% of firms we surveyed were using AI in some way. Of the AI deployments they were using, 80% of them were reported as being in either the latter stages of deployment or in a mature deployment. That's a pretty big change actually versus the 2019 survey. So back in 2019, it was only just over 50%. And now up to 80, so real maturity there. And really critically, I think that this year in 22, last year in 22, the firms projected that there would be a 3-fold increase in the use of artificial intelligence applications over the next 3 years. And I should say also that whilst I think perhaps within the bank, certainly when we did the survey in 2019, we thought that the artificial intelligence use cases might be predominantly in banking, in customer-facing functions, and perhaps in areas like hedge funds and proprietary trading firms. Actually, we saw a really broad-based deployment, including in areas like insurance. So this will be a very clear area of focus for us going forward. And in particular, I think we're going to drill into areas like model risk management, data quality, and governance, and the responsibilities of senior management.
Thanks, Tom. Actually, it's interesting because José Manuel Campa talked about one of the priorities for the EBA is the use of AI in internal model development. And while I want to come back to the theme of data in a moment, maybe Lukasz, I pass over to you, as you have looked also into the use of AI within your supervised banks. Maybe I ask you to respond to Tom and see how that matches up with the work you've done in the SSM. Lukasz? Oh yeah, good.
Thank you. So we see definitely that data is already, transforming the banking landscape, and we see banks using more and more data, also alternative data sources, like let's say mobile, for instance, data for credit scoring. At the same time, in a similar way as just describing the Bank of England, we also look how advanced technologies, AI, data play the role in the way how we supervise the banks and how we perform the banking supervision in Europe. And definitely, similar to Bank of England, we took very consistent approach and built the SSM digitalization blueprint, which outlined our vision for the European banking supervision on how to best harness the power of data, how to embark on using AI in our processes, and on top of the vision, we put also concrete action plan how to achieve that. And what I would like to emphasize is that on one hand, we have included a wide range of use cases that where we see the highest potential to be achieved in terms of the business value. And on the other hand, we defined a set of enablers that would allow us at the ECB to implement the use cases and to really successfully transform the way how we do the European banking supervision. After it, and that work has initiated at the end of 2020, and today, just 2 years after this, we have 14 tools or platforms live, enhancing the work of supervisors across the Europe. And we have more than 1,000 supervisors, the leaders also at the SSM, that have been trained on AI, on innovation, and through that I think we were able to change the mindset and also the way how we work and how we embrace all these new technologies.
I think, Anita, you're advising clients on meeting their supervisory requirements. And when we spoke before, and you highlighted both the challenge of access to data, but also in the modern environment, what it means for liability around different parties being involved in the process through outsourcing arrangements and other arrangements. So having listened to Tom and Lukasz in their initial reactions, how do you see it on the ground? How are clients adapting to AI or supervisory tools using AI? How do you look at how banks themselves are transforming to introduce digital solutions?
Thank you. And fascinating listening to both Tom and Lukasz. And I come at life very much from a transformation perspective. I'm not a supervisor and don't claim to be so. And I think that whole point around data quality and supervisory mindset is really important and refreshing to hear. If I think about how the innovation landscape that Lukasz referred to has shifted in the last 10 years, that I've really been heavily involved in and around innovation and financial technology, then I think what we've seen is a move from firms, fintechs in particular, coming in and looking at competing with the big end of town, to a much more complex environment now, where AI really does play an important role, but not as a, sometimes we can talk about AI in the abstract. And what I'm seeing, and what I think what we're seeing in the market, is much more of a move to issue-based focus, where AI really plays a role. So if I bring that to life, certainly in the UK, we've been through the Khalifa review, we've set up the Centre for Finance, Innovation and Technology, and those things are saying there are issues in financial services that inhibit our ambition in financial services as a country, as firms, as individuals. And those issues are wide-ranging. They can be our digital identity. They can be, how do we deal with payment fraud? They can be, how do we increase the ability of small businesses to access financial services? And I think both the beauty and the risk here is getting down to a level of specificity and really honing in on the use of data and the use of AI to deal with those problems. But to your point, that then creates, if I then step back from that, that creates a really interesting dilemma for supervisors. And as I said, we've got some amazing skills and capability on this call, but it creates a really interesting dilemma, doesn't it? How do you look across an increasingly fragmented market, a market where people are really collaborating and honing in on these issues, and a market where increasingly all of those players are coming together to create interesting new propositions and services that aren't wholly owned by one institution. And so being able, from my perspective, I'm really interested in increased adoption of a range of technologies by small businesses, by users, but how do you create a safe environment when you've got all of these players coming together? And you can't, as you look across that value chain, you can't necessarily pinpoint where things like liability sit, and that can be liability around an individual product, that could be liability when data, and I think it was Tom who referred to the use of external data. When you're bringing in data from so many different sources and some of that goes wrong, where does liability sit in the value chain? I think that's a really interesting problem for supervisors to think about right now.
Thank you very much indeed, Anita. And before I come to you, Marius, just to remind the audience again that there is the Q&A function. We've had very lively participation, and just because I know maybe others joined this panel compared to some of the others, please do feel free to submit questions, which I will bring into the conversation. Now, Marius, we've talked before about the power of technology in transforming financial services, and you actually gave us a very interesting example based on Ukraine and the situation in Ukraine. Maybe we can start with that. But I'd be more generally interested in response to Anita, also what you see, how technology is transforming traditional financial services.
So thank you, first of all, for having me on this very interesting panel. And I agree, we definitely have a very diverse set of experienced people, and we really can have a very involved discussion. But to your point, and starting from a very concrete example of how technology enables us to do things that sometimes were not feasible or thought to be feasible, relating to the panels and discussions before on cloud in banking, usually then we think of digital transformation, huge bill, lots of integrations, and multiple years of actual work. But the biggest private bank in Ukraine went from infrastructure-based data center infrastructure to cloud in 2 weeks, because that's how much time you had. So with that example, I just want to say that it can be done if you have to. And technology really enables us to do things that before were not thinkable. And in finance, we are flooded with a lot of data. Some processes that were not feasible before now are mundane activity. Scrolling through potential insider trading data is a day-to-day activity of capital markets supervisor, which was not feasible when orders and execution of trades were taken in open shout and call manner. But that also creates an expectation from supervisors that now you also have this technology available. So why don't you execute that in a better sense? That's not good enough to do firm by firm supervision and once in a while on-site inspection, because you have also the capabilities of all the instruments that the market is using for their own benefit. So why don't you have an online supervisory framework and emphasis on online? Why to have these cutoffs? Maybe a flow of information which goes through the filter. But then we hit, and that's my second point, limits to supervision. There always have been limits to supervision. And the most concrete one is cost and resources. If before the technological age, we measured that in full-time employees and the budget that we could allocate to third parties that helped us in implementing supervisory tasks. Now it's limits of signal extraction, how much actually we can get from the models, how much can we utilize that. And I guess we are like this dog trying to catch its own tail. We want to ensure our constituencies that products are safe, that those institutions that gamble with your money are doing it in a responsible way. But we cannot be like these other snake oil sellers trying to sell certainty. There is uncertainty. There's always uncertainty, and that's the limit of supervision. And we always are trying to get to that point, utilizing the best methods available to us. So technology is eroding this threshold, but it's moving further away as we speak.
Thank you. Very, very interesting initial thoughts. I think one thing, there's a number of themes that have come out of this, but clearly one of the consistent themes, Tom, is data. So if you use, if either your supervised entities or the supervisors uses AI applications or technology-based applications, ultimately you said yourself, it's about the availability of data, and meaning that it's the access to data, it's the quality of data, it's around the standardization and the ability to share the data. How are you looking at this aspect around the use and quality of data?
So we had a big review in 2019 led by Hugh Van Steenis, who came in as an independent reviewer into the bank. So it's the Future of Finance Review. You can find all of that stuff on our website. That told us that supervisors in the UK receive over 1 billion items of supervisory data each month. There is no way they can review that. and they certainly can't review it with some of the frankly quite out of date techniques which were being used. So tons of data. Also, and we were very upfront about this, expensive for the regulated sector to provide. So we estimated that the cost of regulatory reporting was in the region, and this is a very wide range, I'm afraid, was in the region of £2 to £4.5 billion a year. So loads of data and considerable cost. And for us, it was a priority to have a world-class RegTech and subtext strategy to allow us both to reduce those costs, to better manage that data. When I first started as a supervisor, I mean, one of the things which I was always told is essentially the biggest crime you can commit as a supervisor is to receive some data and not look at it. So big cost, lots of data that's difficult to manage, but also we want to be more effective as supervisors. So also can we use some of these techniques and tools to improve our supervision, to modernize it, and also critically to make sure that the role of human judgment is preserved and promoted, actually by allowing, as Marius said, tasks which now in the modern day look mundane to be automated, and to allow that data and those analytics to give us fresh insights and to support what is a judgment-led supervision approach. So it's not mechanistic, it's judgment-led, and actually using some of these techniques to improve the value add of supervisors and to give them time to really be making a difference. So we've been working together with the Financial Conduct Authority on this data and RegTech strategy, and that's an ongoing exercise. A couple of points, maybe just reflecting on what the other panelists have said. I think there is a really interesting question about novel data sources, as Luke has mentioned, both within the supervisor, where we're thinking about this, particularly for its predictive qualities, but also use in firms where there are some very real issues, particularly I think around conduct of business and the fair treatment of customers. What does it mean to use unstructured data, including unstructured data which comes from external sources? Potentially it could really break down some of the problems we find in finance, particularly around things like inclusion, people with thin credit files, for example. But it's got an absolute heap of issues in it around quality, around bias, and it's very difficult to scrutinize, particularly where it comes from external sources. So I think both supervisors who do want to start using unstructured data, but also firms who are already making use of it are going to have to think very carefully about that. The second thing, which I think is really important, is the point that Anita mentioned. I mean, I'm finding this actually in our work on a digital pound. There is this absolute resistance, I think, in the central banking community, for good reasons, to be pretty close-minded on things like open source, to not be hugely keen on the idea of collaboration around building technology products and analytical products, and also not really to consider the possibilities of co-creation. It's interesting that in our work, I think with MIT in the US, I think they've been a bit taken aback by the fact that we don't think open source is something we're particularly interested in using, because for them it's the first answer for most things. So I think we may have to be a bit more open-minded on the idea of things like co-creation, open source, and that's not just in the area of data, it's in a whole heap of areas. And then I think also, and I think Marius mentioned some of this, we should probably also have a think about whether some of the things which have perhaps been features of the fintech world, maybe the digital assets world, which maybe haven't always worked out so well, but whether those kind of very fundamental technology concepts around transparency, auditability, embedded compliance, actually whether those could change the way we supervise and also the way the financial system works for the better. So, you know, quite a lot for us to think about there. And, you know, perhaps a bit of, as was mentioned earlier, mindset change needed.
Tom, I come back to some of the very interesting points you've raised, but just one short follow-up question right here, right now. You talked about the amount of regulatory data that the central bank is receiving, that the Bank of England is receiving, and I guess any supervisor. What is driving that? As you were asking, as you were saying this, I was writing down we've got replication of regulatory data. So you've got different pieces of legislation requiring more or less the same information, but it's not streamlined. At the European level, there's an effort to come to supervisory convergence, but I think before we get there, I might have lost my job or be gone. It might take a bit too long, but kind of is there, to some extent, is it built into the regulatory framework? Second question is, to what extent is a supervisor comfortable in receiving potentially less information, but a more risk-based or more targeted set of information? Or is it really more about having smarter technology, machine readable data, so that you still get the same volume of data, but you are just smarter in extracting the relevant bits out of it that are important to you?
Yeah, well, really interesting questions. I've been out of the supervisory and actually, frankly, sort of regulatory policy world for a while, doing fintech and digital currency. But I was deeply involved in the UK implementation of Solvency II, which is not something I always advertise, frankly. And I mean, a couple of thoughts there, because for me, I mean, many of the delays and a lot of the cost, which was considerable, a lot of that attached to the balance sheet and some specifics about the UK insurance sector. But just casting my mind back, a lot of it seemed to relate to reporting, frankly. I think there's a couple of issues, actually. So the first one is these institutions are really complex. And if you want to gather data on them and you want to do it in a reasonably comprehensive way, you will end up with a lot of data. I mean, it sounds like an obvious thing to say, but it's true. That's one part. Secondly, many of these are global organizations with global reach, and quite rightly, certainly in the UK, but also in the EU, the approach is to try and do a proper job of group supervision and to truly capture the totality of the operation of these multinational corporations. If you do that, you're going to get A, a lot of data, and B, a lot of data prepared on different accounting bases, you know, reflecting national and local reporting conventions. That's really hard to manage. And then thirdly, I mean, if I looked back at that you know, initial period of Solvency II, one thing I think it's perhaps sometimes difficult to do is to realize that regulatory reporting, and particularly things like taxonomies, are something that you actually need to have your senior management engaged with from the very start to make sure you're gathering the data you want to gather, because it can be left to the experts and then perhaps it won't reflect actually the sort of supervisory philosophy or supervisory approach you want to have. Because ultimately the data you collect has to represent your philosophy around supervision. And I mean, it's quite interesting also that many of these data kind of steps are, they're going to live for a long time because people have to make substantial investments. So when Solvency II first came in and or was first being negotiated sort of in the 2010 type period, I remember a lot of concern in the bank that we would be forced to do sort of line by line audits of asset portfolios, and real concern about the level of granularity of data we'd be having, because we thought it didn't match our kind of more judgment-based approach to supervision. Actually, roll that forward today, and the insurance data is widely seen as being of excellent quality because it's granular enough and timely enough that people can actually do high quality analytical work on it. So it just goes to show that with the passage of time, that's gone from being a concern that what we do with all this information is going to lead us to supervise in a way that we don't think is the way we want to do it, into now something where, you know, analytics, research, and sort of more dynamic forms of supervision are really possible because of the quality of the data.
Thank you. Yeah, interesting thought. Kind of supervisory capacity is caught up with the flow of data available in a way. Lucas, how do you see it, having listened to Tom? Do you face the kind of same challenges or questions? I liked in particular Tom's point about first thinking about the supervisory culture and objectives and then look at the reporting framework. But in the design of your 14 applications that you mentioned around AI in the supervisory process, what type of thought process have you kind of gone through? What type of steps?
I think that just on that question, maybe in our work on innovation, we always put the user, the supervisors in the center. So it was not the case that we started to look this technology, that technology could help look interesting, but we look at the supervisory processes and the pain points supervisor may face that could be solved with digitalization. And I remember that was exactly in 2020. We got more than 100 various ideas. We grouped them. Many of them were of similar nature. For example, related to use of reporting data, to use of the textual data. And once grouped, we prioritized. And this is the way how we built the portfolio of quick wins and more strategic projects. I always said that it was a kind of dynamic portfolio because we see new supervisory problems coming that could be solved with technology. And at the same time, we knew it that after some investigation phase and running the pilots, probably some of these problems could not be solved in a way how we would expect. They wouldn't bring the business value, or they would be too difficult to implement from a technical perspective. But in a nutshell, keeping the supervisory problem, in the center and looking how technology could address that was always the key priority for us. And coming maybe on the data, let me comment on that. Of course, data is fundamental and is key in the work of supervisor. We need to look at the quality of the data, as Tom said, timeliness and accessibility. And one of the issues we have seen at the ECB was that data was often scattered across different systems. So we had that data, but not experts that needed this data could not always access this because that was in different systems that they may not have the access to. And second, also the data sets, they didn't always speak to each other. So there was a different taxonomy that also Tom was referring to. So what was really fundamental for us to foster data-centric organization and the use of data was to build a single data lake where all the relevant data were put and are now available, of course, according to the relevant access rights across the organization. That not only allows for more convenient analysis, benchmarking, all the horizontal, drawing all the horizontal insights, but also having the data in one place is a really key enabler for building further use cases in the use of AI or advanced analytics. So we found that very useful and really badly needed. Yeah.
I have two follow-up questions to you, Lucas. One is, if you look at those different uses, can you give an example of some of those use cases? And the second question is bringing back to Tom's point. When you talk about data, are you looking at supervisory data that's already provided to you on the CRD and other Prudential requirements? Or do you also start to look at some of what Tom described as novel sets of data? So data coming from outside the supervisory framework.
Yeah, let me, thank you for this excellent question, and it's so good always to be very practical and tangible. So one of the use case that we have successfully roll out is named Heimdall, and that use case is about supporting the fit and proper assessment process. So as you know, the future members of the boards of the credit institutions have to undergo the fit and assessment process by the ECB, and for that they submit a kind of questionnaire and the various attachments that will allow supervisors to provide opinion. We have seen this process to be let's say a perfect one for advanced analytics. Why? because it's a massive process. We have more than 2,000 of these decisions taking every year. And second, the data for that process were already provided in kind of form. So all of that was unstructured data, they were a little bit of structure that allow us to use machine learning capabilities to draw, to support the decision making. Of course, AI will not make a decision, but it's a helping factor and can highlight red flags, which will be investigated by the supervisor. The other example that I would like to bring maybe on the table is that digitalization and innovation is not only about AI and machine learning and all advanced technologies. What we see in our organization is that you can get a lot of benefits from using robotic process automations. We have a lot of repetitive processes that could be automated through the use of RPI or workflows, and really relieve this often cumbersome, tedious work from staff and allow them to focus on more value-adding tasks. And in the last year, we have implemented more than 50 robots to support this kind of administrative work, and I hope also bringing a lot of satisfaction and joy to colleagues, because they don't need to perform that.
We see the number of applications for jobs at the SSM mushroom after this conference. It's good to hear. No, it's interesting because I thought you would talk about liquidity models or counterparty risk models. I didn't expect you to talk about unstructured data related to fit and proper CVs and applications. It's an interesting example.
I'm happy to talk on all these, because as I said, we have built a portfolio of more than 20 cases, 14 are live. Some of them are, and I think this is also important to say. Of course, a lot of our work relates to analyze, regular reporting data. Yeah, so when you build also the tools for exactly spotting the liquidity issues, but a lot of also work of supervisors is dealing with the textual information, analyzing news, analyzing reports, all the text that we receive. And when you see all that, I think we have built textual analytics platform that really support supervisors in getting the summaries, getting the translations, topic modeling, and many other features that ease the life and allow for more efficient and more effective supervision.
I find this interesting, particularly if we, in the way we're looking at traditionally individual financial institutions. But Anita, you made the point that in a way the financial market, the ecosystem in financial services is changing radically, and that we're seeing much more, as you described as value chains, much more outsourcing, partnerships, joint ventures, whatever you want to call it, different types of structures emerging around technology. And maybe you can elaborate a little bit more on that. And when Tom talked about novel pieces of information, open source, embedded finance, I immediately more thought of platform operators cooperating with financial institutions, or KYC outsourcing providers collaborating to identify customer behavior, fraud behavior, for example, just social media structures. Maybe elaborate a little bit what you're seeing there and how that has evolved over the last few years, and importantly, how you think it will continue to evolve.
Yeah, and let me start with the continue to evolve, because listening to this conversation, it's really tempting to just keep trying to catch up, isn't it? And you think about market forces, you think about the big tech giants coming in, and we do our own surveys at EY about both consumer and SME propensity to go with those big tech providers, and it increases year on year. But you've also got governments. Last week I was overseas with one particular regulator and government departments, in the EU. We've got the same thing much more publicly in the UK published through the Khalifa review, and we've got governments saying we want to increase the amount of digital access for consumers to financial services. They don't say we want to increase the amount of data, but they definitely say we want to increase the level of adoption. You look at the Khalifa review, it's really explicit around we want to increase the level of adoption. We want to double the size of small businesses accessing finance. We want to double the size of unicorns in the UK. So there's this whole focus on growing and growing that digital footprint, which inevitably will lead to increased amount of data, which I think demands both structure, but also agility from the supervisors as they look across that whole value chain. So you talk about where that could come to life, and we see energy in the market, to Tom's point around coalescing to solve specific problems. KYC, things like digital passports that we've been talking about for a number of years. You see more and more interest, and there were some public letters last week or in the last couple of weeks around this, but you see more and more interest in people coming together to share data for mutual benefit, whether that's mutual commercial benefit from a number of players in the system, but also potentially from a regulatory and a supervisory benefit to share that data. And I think that's really exciting. But the frustrating thing, I'm sure, and I know there's going to be lots of job applications for supervisors now because the jobs have got more interesting. But I think it was Lukasz who talked about mindset right at the beginning. And I think there's something here, given that dynamic landscape and the fact that things are exciting and they are coalescing. And there is something around agility here that I think we've just got to really hold on to.
And actually, it's interesting, Ron Khalifa spoke once or twice at our conference, well before he even set up that commission, being very committed to the whole idea of fintech. But it's interesting, as you say, to hear how collaboration centers around individual use cases, not a pattern across the industry. It's very targeted, where solutions can be brought to bear. I mean, Marius, you kind of normally take things a step further. You're always the agent provocateur, and I mean that in the nicest way, in the sense that when we talked about this before, you said, why are you still in this universe? In the way technology is driving us into a decentralized or democratized form of finance, where a lot of the structures that currently exist will be challenged, are being challenged through this collaboration, through the access to data, and what that might mean for supervision and its future capacity of supervision. Maybe you want to elaborate on that. Of course, we'll talk about Diffie in the crypto space, but I think what you're referring to is a much broader transformation of financial services.
Yes, I'm conscious that we are talking here, about the financial market, but supervision needs a reason, and maybe it would help to think about, it from two extreme examples. The world there is absolutely no supervisory rule book, no intervention, and what would that mean? And maybe there is such a world where we have, such a world, and it leads to a good outcome. And as a macroeconomist, we always have this ideal in front of us. It's called, complete market. A complete market is a market where I can contract on anything that could be out there. For example, someone cheats me or sells me a bad product. So if you sell me a bad product, therefore, and I can observe it, we write a contract and everything is clear, the probability of you doing this and so on. And then in such a world, probably there is no need for intervention, there is no need for rule book, there is no need for supervision. But it requires full observability and enforceability. It's not enough, and I stress here two things, observability and enforceability. It's not enough to have the data and use it, like Tom said it. The question is, what's the action? So on the point of supervisory jobs becoming very interesting, it's the action that makes the job interesting, not just having your hands, full of activity. Where's the action? And I guess supervisors have to be humble. As an ex-supervisor, I say we need to be humble, and maybe we should strive to the world where we don't have to have a lot of action, because that's the good world. And there, it's not to utilize the technology for full observability for supervisory purposes, but quite the opposite. Throw out there to the market players, to the consumers, and ensure that they can write contracts, they can observe things, and we have less jobs to do. I guess that should be the objective. But I'm conscious that these ideals and first best worlds usually do not exist, and there always will be a job for supervisor, and that's where the role will always be. But the onus and the emphasis should not be let's get more data, let's get better insights, let's hire more people to deal with more data. Let's ask for even more data and in different verticals, and that piles on as a cost. That cost translates to something which in medicine is called the side effect of any pill, right? Let's not make sure that we should make sure that the medicine that we're preaching does not create the disease itself.
An interesting thought. When you first started, Marius, I was thinking you were kind of speaking on behalf of all those egalitarian blockchain believers who thinks that everything can be done on blockchain in a transparent way, and then you can see whether there's market abuse or insider trading or whatever for market transparency, because everybody sees everything.
Just for a short remark, if I could.
Yes, of course.
That is exactly the proposition that European Securities and Market Authority has put forward through the DLT pilot regime, and saying, if you choose option A, choose to have an exclusion on reporting, make sure that we have access to the data on the DLT.
Yep, no, you're right. We're in the early stages of this. Let's see how far it goes. My argument is regulation will ultimately mess it up, because when we first looked at a blockchain application in 2012 to basically replace a CSD, I can tell you a long story why all the EU regulation never allowed us to do it. But anyway, maybe to finish off, to each of you, I find this fascinating because it's kind of the first time we're really delving into subtech in this conference. But I think maybe be starting with you, Marius. If you think there was one public policy action that could be taken or should be taken to facilitate the use of subtech or facilitating the level of transparency, what do you think it should be?
I wouldn't be very creative here, but maybe I'll just fall back on what Tom said and make it my own point. If we ask for the data, we should not only use it, it should lead to some action. And if there are no actions, then we should not do what we are doing, because it's wasteful public activity.
I would say lots of AML people would be happy jumping up and down to not have to do the transaction risk analysis or the kind of suspicious transactional reporting at the level that they're doing at the moment. But I mean, Anita, maybe the same to you. If you could ask policymakers to change one or two things that you think would be transformational to your client base and not jeopardize financial stability and consumer protection, what might those be?
I think it's, and I think we've all touched on this to an extent, but for me, as we all get carried away with the excitement of AI and a proliferation of data and what we can do with that, and as the market demands growth, I think there's something about vulnerability and inclusion, and we talk about it, but it feels to me particularly as we get into this increasingly fragmented financial services world that is going to be much more amorphous and will generate the unintended consequences that we've talked about. Actually putting vulnerability at the heart of that feels like the most critical issue.
If I rephrase your answer, do you think that DORA and the debate we had earlier around operational resilience, well, it wouldn't solve the problem, but significantly contribute to it? And how much of a problem would it solve?
Absolutely. As a firm, we think it's a really positive thing, and we think it goes some way to solving it. My point becomes one of, and it comes back to this question of mindset, agility. I just think it's going to be something that just needs to be at the heart of everything that all of us in our industry do.
Thank you. Lucas, going beyond your existing 14 projects, what wish would you have either to your colleagues or to the market at large to further facilitate smart uses of technology in the supervisory process?
And yes, no, I think it's an excellent question and conclusion. I will answer from a technology perspective. I think that really effective scaling of the subtech tools, effective implementation, both from impact, budget and speed, requires cloud technology. And that includes also the use of the public cloud, and the good debate on that, and the critical assessment and showing the advantages of this in all these areas, including the security. I think it's really key, and ensuring that decision-making bodies in the organizations or national legislations allow for use of the public cloud. This will be a great enabler to really allow effective implementation and scaling of the supervisory technologies.
Interesting. And Tom, the same question to you.
So, I mean, I would have offered many of the answers which have already gone. For us, supporting financial sector businesses in making safe use of artificial intelligence is an absolute priority. Our survey revealed that 25% of the firms surveyed felt there was a lack of regulatory clarity, although they did also report that that was a modest constraint, even though it existed. So there's a few areas where we would like to focus on trying to understand where we could give more clarity, and I think this will really help firms with RegTech, SubTech solutions. One of them is model risk management, and the second one is the senior managers and certification regime, so obligations of senior management. Those are discussed in our artificial intelligence discussion paper. That's open for comment until the 10th of Feb. If anybody wants to sneak in some just before the bell comments.
Yeah, and just the last follow-up question, when you talk about the senior management regime, is this kind of the qualifications of the board members and financial institutions themselves understanding what AI is, rather than just appointing a chief technology officer and then going home again? Or is it like Lucas referred to, using technology in things like the fit and proper process by the supervisor?
Yeah, so it relates to both the fit and proper process. So thinking about people who may be holding roles, what they may have to demonstrate to show their capability and competence, but also thinking about the ongoing system of governance and what do we expect from those holding senior management positions with responsibilities and accountability, where it relates to the use of artificial intelligence. So, for example, chief risk officer would be an obvious one, but there's many other positions, and just trying to explore some of the questions for them about knowledge of both the data and the models used in artificial intelligence.
It's interesting you say that, because in previous conferences, iterations of this conference, we started discussing this and just the limited talent pool and what that actually means to the ability of financial institutions to reinvigorate themselves and the type of qualifications that are needed. And I think we might have to come back to that, because there is a clear limitation and challenge there at the moment of people to understand the use of technologies. I really enjoyed this panel. Thank you very much to Anita, to Lucas, to Marius, and to Tom for being with us and bringing a bit of the subtech debate not only to life, but making it actually really quite entertaining. And kind of Lucas throwing in a very interesting recruitment drive there into the SSM. Thank you very much.